There are moments when the market holds its breath for a long time and then explodes all at once. You've probably seen it on a chart before. Price grinds sideways in a tight range and then suddenly breaks hard in one direction. What if you could see that coming in advance? Bollinger Bands send that signal early. The narrower the bands get, the more energy is building underneath. The longer the compression lasts, the more explosive the breakout tends to be. But even when you spot the signal, two problems remain. Which direction will it break? And is it a real breakout or a fake out? Volume filters out the fakes. Every genuine breakout is backed by volume. And once you're in the trade, how far do you ride it and where do you cut? That's what ATR calculates for you. It's a new indicator we're introducing today. Each of the three plays a distinct role. Bollinger Bands identify the market on the verge of explosion, volume confirms the real move, and ATR sets your entry and exit levels in precise numbers. Here's what we'll cover today. Strategy 1. Catching the breakout after a squeeze using a volume surge. Strategy 2. Riding a trend continuation trade using band walk and ATR trailing stop. Strategy 3. Timing a reversal in a ranging market using the lower band and volume decline. Common mistake. When most people first learn Bollinger Bands, they use them like this. Buy when price touches the lower band, sell when it touches the upper band. It sounds logical, but in a strong trending market, this approach can hurt you badly. In a strong downtrend, price rides the lower band and keeps falling. That's called a band walk. Reading every lower band touch as a reversal signal will keep getting you trapped. Bollinger Bands don't tell you direction. They show you the state of volatility, how compressed or expanded the market currently is. Direction needs to be confirmed with volume, and your stop loss and take profit levels need to be calculated with ATR. When all three work together, you have a strategy that actually holds up. The role of each indicator. Before we get into the strategies, let's quickly cover what each indicator is responsible for today. Bollinger Bands tell us the state of market volatility. We covered this in a previous episode. When the bands narrow, the market is quiet. When they widen, a significant move is underway. Today, we use the compression and expansion cycle to time our entries. Volume filters whether a price move is real or fake. No matter how big the candle, if volume isn't there, you can't trust it. When volume explodes, it means there's real conviction behind the move. ATR, or Average True Range, is the new indicator we're introducing today. It measures how much price moves on average over a given period. It was developed by Welles Wilder, the same person who created the RSI. For example, if Bitcoin's 1-hour ATR is $500, that means price moves an average of $500 per hour. We use this number to calculate stop losses and take profits, tight enough to avoid noise, wide enough to avoid getting shaken out. For crypto trading, the default setting is a 14-period ATR. Strategy 1. BB squeeze plus volume surge plus ATR stop loss. Breakout after compression. This is the first strategy. Wait for the market to go quiet, then catch it when it explodes. Confirming direction is everything. Long entry conditions. First, confirm that the Bollinger Bands have compressed into a squeeze. If the bandwidth is near its narrowest point over the past 6 months, that's a strong squeeze signal. Second, price must break above the upper band, with the candle closing fully above it. Touching the band and breaking through it are two different things. Third, volume on the breakout candle must be more than double the average of the previous 20 candles. A breakout without volume is likely a fakeout. When all three conditions are met, enter at the open of the candle following the breakout close. Set your stop loss at 1.5 times ATR, below your entry price. For take profit, use a base risk to reward of 2-to-1. If the bands continue expanding and volume holds, stay in the trade longer. For short entries, apply the reverse. Enter when price breaks fully below the lower band with a volume surge. Set your stop loss at 1.5 times ATR above your entry price. Strategy 2. BB band walk plus sustained volume plus ATR trailing stop. Trend continuation. This is the second strategy. When a strong trend is in motion, stay in it for the full ride. In a strong trend, price rides along the upper band without pulling back. That's the band walk. Selling just because price touched the upper band means leaving a lot of money on the table. Long entry conditions. First, price must be above the Bollinger Bands midline, the 20-period moving average, and candles must repeatedly close near the upper band. When this pattern holds for 3 or more consecutive candles, a band walk is underway. Second, volume must stay above average throughout the band walk. If volume starts declining, that's a warning sign that the trend is losing steam. Third, after a Strategy 1 breakout, if the trend continues, you can add to your position on a pullback. Enter when price briefly dips toward the midline and then resumes its move back toward the upper band. The key to this strategy is exit management. Use an ATR trailing stop. Once your profit reaches 1 times ATR, move your stop loss up to break even. From there, keep raising your stop as price rises. Stay in as long as the trend holds, and let the trailing stop take you out when it turns. If volume drops below average or price closes below the midline, consider closing the position. For short trades, apply the same logic in reverse during a lower band walk. Strategy 3. BB lower band touch plus volume decline plus ATR, risk reward, range reversal. This is the third strategy. Timing a reversal in a market with no clear trend. Earlier, we said you can't treat every lower band touch as a buy signal. So what additional conditions do you need? Long entry conditions. First, price touches or slightly breaks below the lower Bollinger Band. The bands must be relatively flat, not expanding. If the bands are still widening, the market may be in a downtrend and this strategy doesn't apply. Second, volume must be below average during the lower band touch. Declining volume signals that selling pressure is running out. Third, enter when a candle reverses upward toward the midline after the lower band touch. A slight uptick in volume on the reversal candle adds further confirmation. Use ATR to calculate your risk reward. Set your stop loss at 1 times ATR below your entry. In a ranging market, price moves are smaller than in a trending market, so a 1x ATR stop is appropriate. Take the first half off at the midline, and if volume holds, ride the remainder toward the upper band. Only enter trades where the risk to reward is at least 2 to 1. If price closes fully below the lower band, or a down candle forms with a sharp volume spike, cut the trade. For shorts, apply the same conditions in reverse. Upper band touch, declining volume, and a reversal candle back toward the midline. Let's recap today's 3 strategies. Strategy 1. Catch the breakout after a squeeze using a volume surge as confirmation. Set your stop loss at 1.5 times ATR to stay above the noise. Strategy 2. Ride a band walk trend continuation trade to the end. Use the ATR trailing stop to lock in gains and exit automatically when the trend turns. Strategy 3. Time a range reversal using the lower band touch and declining volume. Use ATR-based risk reward to filter for entries worth taking. The one thing all 3 strategies share is ATR. It takes your stop loss and take profit out of guesswork and grounds them in actual market volatility. That single shift can completely change how you manage risk. If you want more chart analysis and trading insights, join our free Telegram channel. The link is in the description. If this video was helpful, please give it a like and subscribe. Your support is what makes it possible to keep creating content like this.